Welcome to this Killik Explains finance video. This time, how to invest money, a quick snapshot and a refresher for more experienced investors. So the bottom line is this: investing isn't easy, but it should be simple, said Warren Buffett, US investor and billionaire. So let's ask a simple question first of all. Why do we do it in the first place? And the answer, I would say, can be broken down into 4 basic points. We all want choice. Building wealth gives us that choice in terms of the way we spend our lives. We want independence. We don't want to be relying on other people at any stage in our lives, ideally, and the sooner we get it, the better. We want security. We want to know that when we stop work, we've got an income of some sort, and we want peace of mind. So if something goes wrong, lose our jobs, emergency, we've got that covered. You could sum that up as we want to live well and, in a lot of cases, leave a good legacy. So that's what we're trying to achieve. Question is, how? Here are my 5 key questions. There are more, but here are my 5 key ones. Number 1, what is your time horizon? So stuff to sort out. What is your time horizon? Is it less than 5 years, loosely speaking the short term? Is it 5 to 10, medium term? Or is it a lot longer than that? Because that will influence, without going into specifics, whether you focus on safety, the return of your money to meet a need, whether you focus on returns, generating inflation-beating returns over the long term, or whether you need to compromise between those two, with or without help. So that's an important thing to think about first of all. Number 2, key question, and it's personal to you, the answer. How much do you actually know already? So for example, do you know about conventional investments, which I would say are cash, bonds, shares, and to a degree property? What do you know about alternatives? And if you don't know anything, don't start piling into them or be persuaded to. That includes currencies, commodities, antiques, art and derivatives. So how much do you know and how much risk are you prepared to take? Coming up in just a moment. That's also key. And even looking at what I call conventional investments, do you know which ones are likely, the past is no guide to the future, to give you the better inflation-beating returns over the long term? So just to take that on, 1965 to 2015, according to Barclays, the green bar is the annual real, that's post-inflation return, based on history, no promise of this in the future, but shares, you can see, have comfortably outperformed government IOUs, and both have comfortably outperformed cash. So that's my point. How much do you know about the asset class you're about to invest in? It's not all about upside though. Do you understand risk? Many investors simply don't. You might say, well, I do, but how many types of risk do you actually understand and how many do you manage successfully? So one of them is price risk. People know that stuff goes down as well as up, hence the regulator's warning. All right, and some things do it more often and more violently than others. That's price risk. In the short term, that can be managed though. What are the other risks I'm talking about? Well, some investments are harder to sell than others. That's called liquidity risk. That's different. Some counterparties are more reliable than others. That's called counterparty risk. We've already seen that you need to be building post-inflation proper real returns over time, increasing your purchasing power. That's called inflation risk if you don't do it. And then there's another big one that a lot of people forget or say, well, it's not me, and that is behavioral risk. Investors can, by their own behavior, make stock ownership or anything else for that matter risky. Who said it? US investor Warren Buffett once again. Basically, there are loads of examples, but panic selling, forced selling, overtrading are all ways that investors can take what could be a good strategy and turn it into a bad one. And I have other videos on that topic. Now, we're not finished yet. Do you want to be involved is question number 4. This is down to you. Do you want to be a DIY investor? Would you like some help? And if so, how much? And are you prepared to pay for it? Or would you like someone else to take it all away from you? Now, I can't answer that question for you, but you need to make a decision about what type of help you want. And what are the costs? Are you paying an annual fee for whatever it is you're getting in terms of investment advice or financial planning advice? Are you paying a per trade commission? Are you paying an initial exit fee? Are you paying a blend of all 3? Find out. That's important. That will affect over the long term how you do. Now some golden rules, just to finish off. I cover these in more detail in other videos, but basically, watch out. As a long-term investor, these are some kind of do's and don'ts. Commit. Investing isn't gambling. This is about time in the market, not timing the market. Get a plan together. Make sure you identify your life goals, short, medium, long term, and get a plan together to meet them. Be systematic. Be a little bit boring. Be the person that shouldn't be invited to a dinner party. That's what investing is all about. Like watching paint dry, as Paul Samuelson once said. Spread your risk, diversify across asset classes and within asset classes across different sectors, geographies and so on. Don't invest if you don't understand it. Don't be persuaded to buy something that sounds sexy but you actually have no idea how it works. Turn off the TV so you don't follow the crowd and never panic. Easy for me to say, less easy to do in practice. If you want to know more, any questions, editor@killik.com, and there are some related videos on this topic at killik.com/learn.